Hey everyone, Jessica Morrison, realtor with SC Tucker Company. We are back with Ross Bromstrup today at Howard Hanna. You would not believe how many times I had to practice saying his last name today. Ross has generously agreed to talk about down payment assistance programs today, grants, and kind of just unpacking that to help you potentially as a first-time home buyer get into home ownership. So Ross, thank you for bearing with me as we did all those practices. How are you?
Thanks. Doing well. How about yourself?
Uh, Feeling a little challenged in my phonetics today, but thankful that phonetics and real estate don't always, I don't know, there's not a grading on
Respond.
that.
Yeah, it needs to cool down too a little bit. It's been a hot one.
Yeah, I could
Um,
always use more water, but
yeah,
what,
so
go ahead.
Howard Hanna Mortgage, we rolled out last week down payment assistance programs that are offered through the state. It's the IHCDA, so Indiana Housing and Community Development. And they offer a couple nice products that us as lenders, we're looking at customers' income, credit, and then also assets. And so to bridge that gap, if we don't have the money for down payment and closing costs combined, Howard Hanna Mortgage, we now have a couple different products that I'll go more in depth over today, and really helps home ownership. Folks be able to
Make
get it.
that attainable.
Yeah, exactly.
Yeah, I feel like I mean, you've got rising home prices, rising interest rates. Now they have kind of come down a little bit. We've been enticed every quarter. The Fed might lower rates and then they don't. We keep getting closer to November. So I feel like it's more likely if they're going to drop it right before that cycle. But um, between those two things and then feeling the impacts of inflation, even though technically inflation's come down, but our grocery store prices haven't,
Yeah.
buyers are just really feeling that pinch on all sides. So, um, how many different programs do you offer, and what can a buyer anticipate with the pros and cons of considering a down payment program?
So we actually offer three different programs within IHCDA. One is a refinance program, but the main two that offer the down payment assistance is the First Step program, and either the First Step or Next Home. They can be offered through as an FHA loan product or conventional.
Okay.
The First Step program offers a 6% down payment assistance, and that's applied towards closing cost as well. Um, and the minimum credit score for both of these programs is a 640 and above. And with a 680 credit score or above, the debt to income ratio gets a little higher, so that's helpful. But for Hamilton County and Marion County combined, a 1 to 2 person household, the income can't exceed 102,900. So, kind of keeping in consideration, I'm taking a look at, what the monthly income is. And, if two folks are making above $50,000, then, we're always, as a loan officer, we're always double checking to make sure that we don't go over that income threshold. And then also the price of the home, it can't exceed $459,090. So
Okay.
unfortunately can't purchase $1 million home with down payment assistance.
Hey, it's worth asking.
Yeah, exactly.
Um, so are Hamilton and Marion counties the only counties that qualify for this program?
No, so counties throughout the state of Indiana, qualify for the down payment assistance, there's just different thresholds when it comes to the income and acquisition limits of the sale price of the home.
Sure. So let's talk a bit about the pros and cons, because when I hear, hey, I could be eligible for 6% towards the down payment on my home, including closing costs, that's a very attractive number, especially when you think about, the $300,000. That's a lot of money we're talking about. So what are the benefits? What are the risks? What questions should buyers be asking to evaluate if that's the right financial fit for them?
Yeah, absolutely. And first, with the first step program, so it's non-forgivable. So that 6%, the homeowner has to live in the home for at least 9 years, or that 6% has to be paid back. So it's definitely something to think about. The caveat to that, as I mentioned, we have a refinance program that's offered through IHCDA that they can refinance, but they're still, encompassed within that program. And then with the other program, Next Home, it offers a 2.5 or 3.5% down payment assistance. Credit scores still stay the same, 640, above a 680 gets us a higher debt to income ratio. But this is a 3-year forgiveness period. So you have to live in the home for at least 3 years, or that amount is owed. So traditionally, when you sell the home, if you have the equity that's built up, take for example, with the Next Home product, that if you gained over that 3.5%, equity, that you have that in the home, then that's just taken from the proceeds, that's paid off, at the time of closing. And both of these, they're 0% interest, so there's no payments, on them, but it's definitely something to take in consideration. It's not exactly free money.
Ah, darn.
Yeah, and it's nice that the interest rates are competitive.
Mhm.
With we're seeing in the 7%, range, for these, so not bad at all. But that's the main factor to take in consideration, is the non-forgivable period for both.
Sure. And I think the important thing is that I'm pretty sure when you said 7% isn't bad, everybody was like, oh, that's still like
Right.
really high. But I think keeping things in context, at least in that situation, you would be putting money towards yourself every month and building equity, and then insulating yourself. Like real estate as an investment is tried and true, one of the best hedges against inflation.
Right.
And so even if you find a home that you're not in love with, it's not your forever home. Could you live with it for 2 or 3 years? And then as you're ready to move up in housing, you're able to financially afford, hopefully, a better product home that is more something of your taste. And then you've cushioned yourself with the equity, market appreciation. If you've bought in a solid area, maybe you've made some cosmetic improvements, or taken that 70s tile out, which I'm sorry if I've offended the 70s lovers in the room, but and brought it up to our current taste. You could really make some good money, or potentially refinance and keep that as a rental. So
Yeah.
I
Yeah.
don't want to be dismissed. Go
A
ahead.
home as an investment piece is, it's a lot of times it's given us our largest return, and it is an investment, and the equity that's gained, simply by living in the home is, comes back. And the theory that you were talking about, it is kind of a stepping stone process, that you have your first home, and then once that's sold, you're getting the equity in the form of the proceeds once you sell it, and you're able to use that theoretically for the down payment closing costs on the next home. And
Yep.
with the First Step program, the 6% down payment assistance, you have to be a first-time home buyer. And a first-time home buyer doesn't necessarily mean this is your very first home that you've ever bought. You just can't have been a homeowner within the last 3 years. But it's going with that theory that, once you've purchased a home, you have the equity, you have the funds available, for your down payment, closing costs on that next house.
Yeah, and I can't speak enough into the eligibility of that because you have some families who unfortunately do go through financial hardship, or just for whatever reason life takes you a different direction and you've not been able to own a home, or it's not made sense for some reason to own a home for 3 years or more. And so when you think about how aggressively the market has appreciated in that 3-year period and the money that you've spent towards renting, I think it's an amazing resource for some people to be able to jump back in. So I love that 3-year or more option is available for people, because I think it's easy to dismiss the impacts of that. So to
And
clarify,
you avoid, typically capital gains tax. If you haven't lived in a home for 2 years, then it's you wouldn't face that, either too as well. So
sure. So to clarify, would you say that the correct expectation for a buyer is to be, if you're using a down payment assistance program, it's considered a loan or a lien on the
yep,
property until that's satisfied. And as you said, it's not interest bearing. It's just that flat, whatever it is, 6% on
yes.
the property at closing. And then if a buyer was to move, let's say in that first example, if they were to move prior to 9 years, would the total of the 6% be due, or is it only what's remaining on the loan at the time of when they go to sell?
So basically, with it being 0% and no payments, they're not making principal payments on it for the down payment assistance, if that makes sense. So it's not necessarily tiered, because if it's within that 9 years, that balance, it is still there. So a $300,000 home, for the sake of easy math, that's $18,000. It's more thinking that, hey, the market is going to produce, and I'm going to have over 6% equity in this home, and then on top of that, I'll have, I'll be able to net some proceeds, on top of that as well.
Sure. So I guess my question was more, if you sell at year 3 or year 4 out of the 9, would the difference that be owed is 6 or 5 years worth of the forgiveness? Does that question make sense?
Yeah, it would be the
Okay.
6%, because you're not liquidating, what was taken out, initially. So
Interesting.
if there were, if there was an interest rate tied to it where you're making principal and interest, payments on it each month, then that would be scaling back, the amount that of the lien that's owed. So
Okay.
it kind of falls into place. 6% is obviously higher than 2.5 or 3.5%. And if you take with the next home product, either the 2.5 or 3.5% down payment assistance, the waiting period is only, the forgiveness period is only 3 years versus 9 years, for
Sure.
6%. So,
Well, and again, like, this product may or may not make sense for certain people. I think it's just my asking these questions is all about setting correct expectations, because the last thing you want is a financial surprise when at any point in the real estate transaction.
yeah.
So to follow up on that, I definitely hear you and agree that the market appreciation rate should outpace, as we've all felt that in our property taxes and recent assessments.
Yeah, they do that too as well.
Your annual appreciation rate should offset any financial that you might need funds that you may need to bring at the time of closing. However, my follow-up question to that is if a buyer was just trying to be really financially frugal, they don't like the idea of a lien on their property, and they wanted to get that paid off, could they make payments specifically towards that balance so that out of that 9-year timeline, that could be not something they have to think about at closing?
Yeah, they could. And then that way they wouldn't have to, at the time of closing, they wouldn't have to worry about it. So, yeah.
Okay. Yeah. So again, as a consumer, that may or may not make sense for you. That's why talking about your specific situation with a loan officer like Ross or having a real estate professional like myself run market reports and help give projections. I like to, as a realtor, stay in my lane. So anything financial related, I always defer to a loan officer because they can get in your file and speak to the nuances of your situation, especially when you've got things like medical bills or student loans in play. There's a lot of different factors that are considered in your payment. So we've got a 9-year term, 6%, 3% down, 3 years. Are there any other programs that you are really fanatical about or anything that's specifically grant related?
So down, not grant related, but Howard Hanna Mortgage, we do have a very attractive product. It's 15% down, no PMI, so no private mortgage insurance. And that's solely for a conventional loan. Traditionally, customers, consumers, we have to put 20% down to avoid that PMI. So, it's a $300,000 purchase, that's saving just alone in the down payment, $15,000. So it's a lot of money and you're still able to accomplish the same goal. And they have good interest rates too as well. You have to have a 700 or above credit score to qualify for that.
Sure. And I think for the consumers, the reason for that is it's a higher risk loan to the bank. So they're going to reserve that for less risk individuals by having a stronger credit score. So, and then for those who are not familiar, PMI stands for what exactly?
It's private mortgage insurance, and you're absolutely correct. As lenders, we assess risk on every single loan. So someone that's coming to the table with 20% down, or, in our case, 15% down, it's less risk, at the time of closing, versus with an FHA mortgage, the interest rates can tend to be lower, but you have mortgage insurance for the life of the loan, on a FHA mortgage. But of course, if it's a credit score, issue that at the time why you didn't qualify conventional, you can always refinance, once your FICO score has gone up into a conventional mortgage and hopefully avoid the PMI. So.
All right, Ross, I'm going to throw a curveball question at you. So as we all know, in Indiana, July 1st, August 17th, on a national level, buyer agency contracts are going to be required. And, at the end of the day, it's nothing really new. An agent will need to discuss with their buyer. If a seller is not offering compensation to the buyer's agent, what's the solution for that buyer compensating their agent? And so that could be adjusting the purchase price to finance that. If the seller doesn't want to finance any portion of that and the buyer can't, for some reason, come up in their price, is the buyer able to pay that in cash at closing? So I preface that because when we look at these down payment assistance programs and you're representing a first-time home buyer, is a buyer, if they get into that position with negotiating where they've maxed out their price to compete on a property, seller's not willing to offer compensation, are they able to, in any of those funds, pay their buyer's agent from that pool of funding?
Unfortunately, no. So with the down payment assistance, it's directly, and it's nice because it can be used towards closing costs too as well, but it's just for down payment, closing cost and prepaids. So,
Sure.
but yeah, we had an announcement in the mortgage world last week that was good. You know, veterans are now, and it's a temporary fix, but prior, veterans weren't allowed to pay any broker commissions. And, you know, they announced the VA that they are able to do that. So, and FHA and conventional loans, buyers are not subject to seller concessions. You know, there's caps on the amount of money that a seller can provide towards assistance, you know, towards a buyer's down payment, or I'm sorry, just closing costs and prepaids. And they said that if the client has those funds available, that they're not subject to the caps on seller concessions for each loan product. So,
Okay.
for
So I did my,
example, with conventional, if a buyer puts less than 15% down on as their down payment, the cap on seller concessions is 3%. So, you know, if Fannie Mae or Freddie Mac were to say, hey, you know, the broker commission is going to be subject to the seller concession caps, then I mean that right there potentially could exhaust that full amount. So if at the end of the day, if the buyer has the funds, you know, available, you know, there's a workaround and, you know, the ability to commission the buyer broker.
sure. I think I'm all for, these lawsuits should have been tossed out from the beginning, but we can't change that. And so I think the outcome is I'm happy that we as agents first are being held accountable to better communicate our value,
Right.
to have a buyer sign off that they understand how that agent is being compensated, and to proactively come up with a solution with that agent so that when they get into negotiations, it's not a surprise or a question in the background of what is my agent being paid. And
Right.
I'm all for that. I think it's going to be an adjustment in consumer expectations to sign an exclusive agency agreement.
Right.
Because now, like when you enter open houses, it's just the domino impacts of this settlement have just been super fascinating to see. But I think where the rubber meets the road is just when you get into these discussions with financing. I do really hate how my compensation as a buyer's agent could potentially either become a negotiating term that gets in the way of, or it feels that way. I think we're still going to kind of have
Yeah.
some test runs here, but you just never want to, all of us as realtors have a heart of service. And a lot of these professionals are second career, former nurses, teachers, firefighters, you know, people who really do care about
Yeah.
people at the end of the day.
Well, and to your point too, you know, realtors and then, you know, lenders, a lot of us are paid, you know, all commission. We don't have these large salaries that we make and, or that we earn. And, you know, there is, nobody works for free. And, you know, there's time and effort that's taken in consideration and expertise, you know, too, as well. And I think with the buyer's agency agreement that it's, you know, there should be some type of agreement to, you know, be doing business, you know, with you guys. And it would be nice, you know, on the lending side, you know, if we had something like that too, as well. I think of it truly as a positive. There's times that people get pre-approved and, you know, possibly another lender approaches them and the time and effort that was spent, you know, sometimes isn't looked at, you know, and if they were to go to a different lender, it's kind of like, okay. So, you know, a lot of times it's just it is what it is type situation. So,
Yeah, I think my heart in saying all of that was just that I really hope that buyers are, um, I think that on some level, like I don't think the pace of the market is going to slow down, but I do think that there's going to be an adjustment on the buyer side that, oh, we need to slow down and have a conversation.
right,
Not just in consultations, but I think there's going to be like 3 or 4 more conversations that need to happen
right.
because of just like I just went through the ABR designation course, and I mean, I kept thinking like, okay, my consultations tend to average about this length, and I feel like it just doubled given everything that we really need to cover and exhaust. And then when you take that into consideration with I need to find a house and I need to get this done, especially if you're working with less than 30 or 60 days, like that's a lot of information to throw at somebody, and it can be done. I just think on
Yeah,
the consumer side, people need to be a little bit more patient or prepared to be a bit more patient and
right.
be willing to have these detailed conversations because it's for your benefit to understand, um, but on the other side, it's just an adjustment because it's very instant gratification with how a lot of these app services work. So
Right.
I'm excited for buyers to have these conversations with loan officers and their agents to proactively understand what their options are with compensating their agent so that there's no, again, financial surprises.
Yeah, there's no unknowns. And the fact that, Jessica, you have had those consultations with your clients prior, I mean, that speaks volume. And there's a level of customer service, but at FC Tucker and Howard Hanna Mortgage, it's about the relationship too as well. And we're always there to help anybody throughout the process and walk them through it. And um, it
Yeah, and
people
that's a
are
big
just a
goal of this.
number, you know.
Yeah, I think that's a big goal of this series too, is to help take this information. And I have a goal of creating a video training series or a video series that helps ensure fair housing in a way, because we need to be saying the same thing to every client. And I may well intend to say the same thing, but we get on a time crunch and I might have to take something off or whatever. And, you still give these consumer handbooks and you check all the boxes, but I've highly considered incorporating pre-recorded consultations where we break down what is earnest money and then giving it into bite-sized sections for the buyer to view at their own discretion. But again, you don't want to offset too much because then you don't know if people have fully listened to that. So
Yeah, and it
um,
comes at us fast too, the home buying process. And it's
yeah,
if you don't have those members or that team that's helping you through each phase of the home buying process, then it's difficult and it gets stressful. And having a team that is there for you and can answer questions, just makes a great customer experience.
or just in the reality that okay, you get home from work, you're making dinner for your kids, put them down to bed, you've had a long work day, and we're going to talk about a lot of meaty information that I'm going to try to condense and make sure that you understand. And you might understand it in that moment, but it might be 2 or 3 weeks before we really need to utilize this info. And I'll remind you, but
Right.
I can't tell you how many times I've communicated something and it's been like, oh, wait. And I'm like, we did talk about this and you signed here and whatnot. But I think that's where having those video recordings for a buyer to go back and refer to something is just going to be really helpful. So pray for me if I'm able to make that because it's a
Well,
labor of
I'm
love.
gonna, do this, in different facets, too, as well. So,
Yeah, and that's why we have different partners too. I think not to tangent too much, but just with home insurance right now.
yeah,
I mean, I can't believe how I feel like this is an area of growth for our industry is insurance is such a like an obvious necessity, and yet it's one of those things that just bites you in the butt if you don't fully understand your policy and your terms, and the
Yeah,
consumer education on that, I feel like is really lacking. And I can dig through all of these different articles, but I'm a bit amazed that, in our industry, the conversation is, well, let me just pair you with a good representative. And I'm like, there's not more educational material we can prepare? Because how do you know that that representative is properly going to educate that person? Or on
right,
the flip side, like they work for that company, how does the buyer know what questions to ask outside of a Google search?
right.
So
Yeah, and that's where the relationships come in, into hand, and you have a wealth of folks that you can kind of farm that and refer them to. And I agree, insurance has gone up along with a lot of other things, and it's something we have to have homeowners insurance on a home, and for our car, in the state of Indiana. And one thing,
every
yeah,
everything's
exactly.
expensive.
One thing I would say, on the lending side is that there's an escrow team that's tied to your servicer, who you make your mortgage payment to each month. And if you happen to switch insurance companies, then making sure to notify your servicer, of that change. And then what'll happen is they'll cut you a check for whatever is still owed of that premium back to the client. And I would suggest that, maybe putting that money back into your escrow account. So it's better to be overfunded rather than underfunded, because then your mortgage payment will go up. So,
Yeah. Yeah. Again, last thing any of us want are financial surprises. And
right. Yeah.
uh, do you, as a lender, have any tips for a buyer when they're evaluating different homeowner insurance providers, or things that you look for?
Yeah. I'm more one that, just experiences and insurance agents that I've worked with in the past, and I trust them. I feel most comfortable referring clients out to them, versus, some of these bigger companies, Allstate, State Farm, Liberty Mutual, things of that nature. Everybody knows them. And at the end of the day, if something happens and you have to make a claim, you want to be able to rely on the insurance company to pay that out. And not taking anything away from any of those three companies, but if your claim isn't paid, then it can make a difficult financial situation for sure.
Yes, I think one of the most enlightening things has been talking with contractors and people who deal with home remediation on a regular basis, because they are on the front lines and they experience working with these insurance adjusters and claims being processed, and seeing which companies actually are favorable to a homeowner and following through on their contract, and which ones are going to fight you and make you almost hire a lawyer to uphold that contract. And which I think is just absolutely horrible, because if you're having to make a claim, it's likely due to something highly severe, like, I mean, outside of wind and hail damage, but like if your basement floods, or a tree fell on your house, or God forbid your home caught on fire. Like, I cannot imagine being a homeowner trying to get my insurance policy to do what they said they were going to do,
Yeah, and if
or
you're
to be,
going to, and again, I'm not saying anything against those companies, but a large corporation, in hopes that they're going to cover that claim, versus, a company. You and I pride our business on our clients, and we have their best interest, because, that's how our business models work. And, certain insurance companies that are willing to go the extra mile, and they're putting the customer first and handling those claims when needed. That's what I would look for the most is, what's the percentage of claims that are compensated and taken care of, and what type of reviews do they have, and things like that, rather than,
Sure.
hey, this is a name, I'm familiar with it, and this is the route I'm going to go. And of course, always the lowest premium doesn't correlate into the best service. Taking a look at the,
Yeah. I mean, I think we can definitely get competitive and just get tunnel vision on the payment
Mhm.
or like that final number. And I would say read those terms and conditions and make sure that you've got adequate coverage, because a number of people, if you've got a basement, you only have $5,000 of water damage coverage most likely. And
Yeah.
that's not going to go very far if you have flooding.
Right.
So I think making sure that you have a full understanding of the extent and limitations of the policy. And then that way, if what, you're like, I don't think my basement's ever going to flood, I'm fine with 5,000, then that
Right.
rather than being, again, financially caught off guard. So I know we deviated from down payment assistance and grants quite a bit there, but I do
All
think that
walks of real estate.
well, it's just all about consumer education and relevant topics, as a lot of homeowners are seeing that increase in policies. And again, coming back to first time home buyers, when they're getting that first policy, um, I would argue it's probably higher than what it was last year with
Right.
rates going up. So
Yeah, and unfortunately too, with property taxes, that's not something we can control. But seeing them last year, go up, too as well. So when you're getting pre-approved, also too having a conversation of budgeting what your all-in mortgage payment, what you want it, the max of that to look like, and that kind of working backwards and kind of fits into the purchase price of the home, that you'll be looking at. So
sure. And I think our goal is never to push someone into housing. And please don't hear that as a consumer that we're trying to quote sell you on you need to buy a house right now. There's some people that you know what, you need to get your ducks in a row and wait a year. But that's where I think partnering with the right loan officers is so important, because then you can get financially educated and see, okay, here's the runway that I'm working with, or here's when I would like to buy based on these financial goals. And a lender can refer you to a financial advisor, and you kind of create your own board of directors of people who can speak into your situation and help you succeed so you can build generational wealth when it is the right time for you. So
and I'm
Ross,
someone that I appreciate, someone that's transparent and will tell me the good, the bad, the ugly of the situation, and that's why we talked to, with the down payment assistance, that the non-forgivable periods is something to definitely take into consideration. So,
sure. And I think again, it could be the right fit for somebody who doesn't have that funding but wants to get into it. But as long as you understand the pros and cons with that, and if there's a financial plan that helps offset some of those risks, then it could be a risk worth taking. But Ross, is there any final words of encouragement or final tips that you have before we close this out?
we offer, it's $1,000 towards your closing costs when rates do come down, as part of our loyalty lend program, when clients decide to refinance. So the Federal Reserve, they met last week and they're now looking at one rate cut for this year. So nobody has a exact crystal ball, but we're working on behalf of clients to come up with products to alleviate and help with the higher interest rates. You know, we recognize and we know that they are where they're at. So.
Well, Ross, thank you so much for your time. If you've watched this video and found it helpful, please let us know, or if there's other questions, please feel free to connect with Ross or myself. We would be honored to help your family decide what direction to take or help you weigh the pros and cons. And if you're not in Indianapolis, know that we have relationships all across the country and even the world to help you make a smart real estate investment with a trusted professional. So thank you, Ross, for your time.
Thanks for having me on.
Have a great day, everyone.